Welcome back to another episode, guys. So bring in your questions today. I released this video at 10 a.m. because we already have markets that are open. It's a break between 10 to 11:30, so I hope you can watch this video and use the information given that the markets are open today. Next update will be on 16th March. I do know some of you are upset with the fact that the weekly videos are not coming out. I'm making videos only, every fortnight. Believe me, it's working in your favor because unless and until there is a major update, it means you have to carry on with your medium term positions. Do not get trapped with the short term volatility that is playing out in the market. And if and when it is required on a serious note, an update will be given to you. I won't leave you hanging at all in the market. So we'll continue our discussion from the last week's episode. So basically, I explained where we are in a bull market cycle, and we are roughly in year 3 where value gets more importance than momentum. That is, the current market leaders will not be performing as well as they performed in the previous cycle, and the value plays in the market will kind of catch up. They won't necessarily perform like the super performers of the previous cycle because mainly this is the Nifty 200 large cap kind of a space, but the returns will be at par or higher than the momentum plays in the market. And then finally, when this particular stage starts, I'll update about it. So the first thing I would like to point out is about volatility. So if you see the title of this video, this title of this video is buying stocks in a volatile market. How do you make sense of the short-term volatility that is playing out? And I do know for a fact that whenever the market is getting a bit volatile, any position that you've been building in recent times, if it is giving a loss, you're more inclined to cut that position. Don't get frustrated just because you cut out the position and next day the market moves up because of some event, and then you think, what a fool you have been in cutting out positions. Let me tell you, in the long term, discipline wins big time. Even a lot of events, when they play out against you, in the long term, your discipline will win. And let me explain this with historical charts. So this particular chart is of Nifty, that is between 2005 and 2008. This is the 2008 top. Now what happened? Yes, you see Nifty rallied more than 80 odd percent, but look at what was happening. This is a 14% correction. This is a 31%, 10%, 10%, 16%, 14%. All these corrective moves are 10%, and then finally the big 20-30% decline came in the market. The reason why I have pulled out this chart for you is because of the basic structure of the market that I discussed in the December last week video, that is outlook for 2024, that will remain very volatile this year, but broad term trajectory will be up. All right. Now, when you see broader market indices dipping 4-5% and you cut your positions in stocks by 33% or 66%, let me tell you, you are doing the right thing. You're doing the right thing because in a volatile market, a minus 5% correction becomes a minus 15% correction. Sometimes a minus 5% correction also becomes a minus 30% correction. A minus 5% correction also becomes a minus 10% correction. I hope you get the point. So this is actually an exercise. This is basically a habit of a successful trader, that you have to move with the market. And whenever you see these corrective moves getting over and again market printing wide range candles on the upside, you should again start building positions. Nobody, or rather I would tell you, it is a rarity that people blow up their accounts by cutting their positions quickly when it comes to taking losses. People blow up their account by taking leverage, by not cutting losses, especially in the FNO segment. All right. So whatever you are doing, it is right. Don't worry, these whipsaws will happen. Last couple of weeks, I've been whipsawed left and right in my positions, but today again I started building positions. So that is the nature of this game. That is how nimble you have to be. It is completely fine if you've got shaken out of your recent positions. Your core portfolio positions, the winners of the market, winners of your portfolio, do not overtrade them. Do not go in and out, because those are winners that are going to grow probably 1x, 2x, 4x for you. So I hope this particular point is clear. I'll also take you to one more data point. This played out between 2017 and 2020, the same kind of volatile movements happening in the market. This is a 5% correction. This is a complex kind of 5% move. This is 11% move. Again, a 5% move. Then a 15% move. Then a 12% move. And then finally, a couple of 5, again a 4%, an 8% move, and then came the COVID fall. The point I'm trying to make is that when you start cutting positions here, that is mainly short-term positions, yes, in the short term, it may seem as though you are getting too bothered with the short-term movement in the market, but it is not this particular way, especially once we have had an extended move in the market. You know, a lot of us have grown up in times where we used to hear a story. This story is a Hindi story, but I'll try to translate it in English. The appeal obviously is in Hindi. The story goes that a boy in a village kept shouting every night that a wolf is coming, wolf is coming, wolf is coming, or he's seeing a wolf. And then one fine day, the villagers say this boy is a liar, and eventually the wolf comes and he kills a lot of people and those kind of things. The market, as of now, with the kind of volatile moves that is happening, is telling you a correction is coming, and a correction is coming. And one day, let me tell you, that correction will come. But because every now and then the market falls 4-5% and it bounces back with great momentum, do not make the mistake of being casual. Because I'll tell you, majority of market participants will do this. There will come a time where people, after seeing a 4-5% fall, will think this is just a normal movement, market is going to make a new high, and that month market will tank 10, 15, 20%. So it is your discipline in these phases that is going to protect you from something that happened in 2020 or something that happened in 2008 or an extended correction that you saw in 2017 and 2018. So with respect to volatility, there are 5 broader points that are playing out. Number 1, adjustments to positions are frequent in nature. By this I mean there are a lot of you who are swing traders who then convert your positions to positional kind of a trades. Within that, a lot of in and out will happen, which is fine. Do not run away from the process. Number 2, frequent stops are being hit. This gives you a feeling as though you don't know much. It gives you a feeling that the market is not right. Always trust that message. Whenever logical stops are being hit frequently, it tells you that the market is not conducive for a lot of aggressive plays. I'll come to today's movement also. Number 3, within volatility, you can clearly see that breadth has deteriorated in the market. Now, there are a lot of ways to measure breadth, but I'll talk in terms of the common ways to measure because I know many of you do it that way. Number 1, stocks below above 50 DMA, below above 200 DMA. If you see those breadth data points, they have been moving lower since December 2023. That is mainly because there is a lot of volatility in the market. It's also because of a larger theme I've discussed, that mid, small and micro cap space will gradually see outflow, and it is the large cap space which is going to get allocation. So as of now, whenever correction is playing out in the market, whether it is short-term correction or whatever, money is moving out from small, mid, micro cap to something like large caps. And the fourth and the most important point is shakeouts are happening due to FNO segment. So you cannot shy away from the fact that the FNO volumes now are 389 times of cash market volumes, which means everyone, or the ill-informed one, let me put it that way, are bringing in a lot of volumes in FNO. And whenever this happens, you're seeing call options go from something like 10 to 300 in a day, put options going from 40 to 800 in a day. That's a massive shakeout. You're seeing gap down happening, then a follow through, gap up happening, and a follow through. It is all these FNO traders that are being shaken out in the market. For equity traders like us, that is good news. It is good news because we will get frequent pullbacks, we'll get opportunities to add to our massive portfolio winners, and we'll get the opportunity to compound money. So as an investor and trader, you have to ask yourself, what is your risk tolerance in the market? If you're a conservative trader or an investor, then 80% of your allocation has to happen in value related stocks and sectors, and 20% needs to happen in the momentum plays. I'll come to all this in much greater detail. If you're a moderate kind of investor trader, 60% has to go to value and about 40% needs to go to momentum. But if you're an aggressive trader and investor, then 20% needs to be in value and 80% needs to be in momentum. That is the fresh allocations, or if someone is completely new to the market. Now, what are the combinations? For a conservative trader who will have 80% in value and 20% in momentum, the value lies, as I explained in the December 23 video, in banks, finance, FMCG, metals, consumption. Realty I've added last week because it is again offering good risk reward. If you're a moderate investor and trader, your combinations have to be bank, finance, FMCG, metal, consumption, realty, some bit of auto, defense, and PSE stocks. So these are relatively risky sectors out here, but 40% allocation. If you're an aggressive trader investor, your allocation has to be mainly in realty, auto, PSE, defense, oil and gas, energy, infra, and then some bit of banks, metals, FMCG. I hope you understand how you need to mix. But the first question is you got to ask yourself which category you fall to. And then what I will now teach you is, if you decide you're a conservative trader investor, I'll pick up an example of something like banks, because banks is something that I discuss very often with all of you. It's my favorite sector, and I'll just show you how to read what is happening. So this particular candle is today's weekly candle. Actually, it has gone past this level, but I've taken a snapshot, I think at 12:30 p.m. or thereabouts. So what is happening in Nifty Bank? The first contraction that happened in Jan 23 was minus 12%, then minus 9%. That is from this peak to this particular low. And in recent times, from this particular peak to this particular low, it is minus 8.71%. So each contraction is a bit shallower than the previous one. And now you're seeing Nifty Bank is again attempting to move up. Now this is on a weekly time frame chart. If you plot Stan Weinstein's 30 weekly moving average, you can see Bank Nifty is exactly taking support somewhere near that. All right, this is the weekly structure. On a monthly structure, after some bit of volatility in Nifty Bank, this particular candle is now becoming some sort of a mother candle. A mother candle is where a lot of candle rotation happen and then eventually a breakout or breakdown happens. Within this particular wide range candle, you're having some bit of long tail here, and you're also having some bit of long tail, but also with long wick. So if this particular candle screams bullishness, this particular candle screams the sellers are also present at higher level. Third candle tells you this is indecision, which means neither buyers or sellers are in control. So in the very short term, I think this particular line has been taken out. It is imperative that Nifty Bank sustains above this particular level, which is 47,255 and 47,374, because this is an indecision candle high. And the sooner Nifty Bank sustains, that is, the longer it sustains above this, the higher the odds become to hit an all-time high or to go higher. So this is about the monthly time frame. Then comes the daily time frame. Now what I have here is a 200-day moving average. Now Nifty Bank, let me tell you, this is the 50 DMA. This is the 50 DMA wherein price breached it, spent some time, and again it is now attempting to move up. Again, this candle is outdated. This candle has moved very close to this particular point, or I think above it also. The next slide is the 200-day moving average for Nifty Bank. Can you see it is moving down here? It is just touching here, again moving down here, moving lower here, and now finally it is attempting to move up. By the way, look at what I've written. At every point, that is 1, 2, and 3, I was of the opinion that this is a valid breakdown, and the markets can head into some sort of trouble. Because again, that is the job of a trader. The job of a trader is not to showcase his skills about being right or wrong, maybe to an audience, to his friends, to his Twitter profile, and those kind of things. I'm telling you this because we are in a social media kind of a world where somehow we perceive our image to be greater value than our money or account size. At point number 1, when I thought markets were in trouble, I did speak about it. At point number 2, I did speak about it. At point number 3, I did speak about it. And at every instance, I was wrong. But that does not mean that I have not made money in banks. It means my opinion was wrong. And this is where you have to be proactive when it comes to trading in the market, even for the medium term. I'm a medium term trader, I'm not a short term trader. Your opinion can tell you that price is going to head lower, but if you see pivot breakouts happening on the upside, you have to take long positions. See, at point number 1, 2, 3, it is not that I'm exiting my portfolio, but I'm being cautious. And being cautious in the market is healthy. It is healthy because you'll be proactive in protecting your profits, you'll be proactive in cutting down your loss-making positions, and you will be proactive when it comes to overall capital protection. See, whatever noise you see on Twitter, on YouTube, and various social media channels, it is also largely driven by those people who have never seen a 2020 kind of crash, to 2008 kind of crash, or the grinding market of 2017 to 2018. All post-COVID traders and investors have seen is market going up, then some correction, again going up. All right. So if you hear an advice that when price is below 200 DMA, it does not matter, price is eventually going to go up, that is not correct. It is not correct because it is being given by those who have never seen what kind of destruction happens in price below 200-day moving average. That is why whenever you are seeing market breaching 50 DMA, 200 DMA, take note of all those stocks, trading positions in your portfolio that are currently giving you losses. See which are violating pivots. You have to cut it out. You have to cut it out because always tell yourself a minus 5% can become minus 10% very quickly. A minus 10% can become minus 25% very quickly. If you have doubts about what I'm saying, go back to my December video and listen to my remarks about railway stocks, some sectors I don't want to name, and look at small mid micro cap segment also. Look at the winners of those cycle, look at where those stocks are today. Most are down between 18 to 27%. It has happened because when you keep chasing momentum, when you keep chasing stocks that are moving up for that particular month blindly, eventually the market starts reversing. And where has the money flown? The money has partially moved to large caps, and I think during the year, if the US markets remain stable, this trend will continue. So this is how basically, so this is the updated candle, I think. So we are just about at that level. I would want Nifty Bank to move above this and sustain above this. Because remember, Nifty Bank is again trying to move above this particular stage region, but there is one more stage region here. There are a lot of candles here, a lot of up and down movement has happened. So when it moves above it, it's going to pause maybe for 2, 3, 4 sessions, and then let's see if it has the capacity to break out again. So this is the kind of homework that I do for Nifty Bank. Why I have put out Nifty Bank? Because my preference currently in the market is banks, finance, FMCG, metals, consumption, and realty. I'm in this basket. And the momentum plays that were there, I already have position in that. I don't want to add too much to those names because this is where risk reward is and this is where momentum is in the market. So you have to decide as a trader whether you want risk reward or you want momentum. The thing about risk reward is that if Bank Nifty is somewhere here, let's say, let me pull out the chart here, and you take a position here, at the most your risk will be at the low of this candle. But in momentum plays, if you're trying to add positions today, your pivots, the trending pivots, minimum are below 20%, 25%. It's very difficult to trade those structures. I'll take a couple of more sectors as an example. So this is a long-term chart of metals. I've shared this with you also. Again, the similar concept, minus 36%, minus 24%, minus 11%, and a breakout. I've already said, look at the kind of long tail candles that are forming here. So in metals, it's my specialization is the banks and finance sector. In metals, I just trade a couple of stocks. One is the legendary Tata Steel. Then it is JSW Steel. There is a mid-small cap company. You have something like JSL, and I have JSW Steel. These are my favorites. Then of course you have Adani Enterprises. You have something like NMDC, and those kind of names. But my all-time favorite stock, of course, in the metal sector, and I've spoken about this many a times, is actually Tata Steel, because I do understand the price action of Tata Steel inside out. And the next sector, that I'll cover is the realty. Now, realty is a sector that has rallied a lot. But if you clearly look at the chart of realty sector, you clearly see this particular contraction. And then a breakout has happened. We are retesting it. So all the names, DLF, Godrej Properties, Oberoi, Sobha, Macrotech Developers, all this has to be on your watch list. Realty is also one of those sectors that is offering both momentum and risk reward. And this pattern for me is really, really beautiful. And it just signifies that the potential here in this sector is much higher. The next sector I'll come to is FMCG. Now, FMCG is one sector that's not done much. Look at these candles, look at these wide range candles. And now the price is precisely taking support at previous resistance here. Now, this sector, has the likes of, this is a long-term pivot out here, trending pivot that is. Now, this sector has the likes of HUL, it has IDC, Nestle, Britannia. Again, beautiful structures forming in this particular sector. You just got to see where relative strength is, plot it out, check the strongest names, and those should naturally come in your watch list. So now I'll bring you to the quadrant that we've been studying. So this is the signs of leadership that is undervalued, underperformers. Here I had classified the likes of SBI, ICICI, Axis, Tata Steel, and a lot of FMCG, those kind of names. This space has not corrected that much. But if you check the recent times where the market has pulled back, Nifty in a range, mid cap, small caps have fallen a lot. A lot of this space that is overvalued, outperformers have corrected 25 to 35%. Now my focus is actually on both these spaces, the space that has corrected here 25-35%, and mainly but in the undervalued, underperformer space where risk reward is better, the odds of losing a lot of money is also limited. So now let me show you how the positioning has to be done in the market. I've divided this into three parts. That is the risk reward phase, the momentum phase, and the balance phase. I'll just show you in a bit. I have to make a disclaimer, this is not a recommendation. And this is only an example that I'm sharing because I have explained the banking sector. So in this particular table, you see the risk reward here, the momentum here, and the balance phase here. And what I've done basically is use relative strength, is use basic valuation metrics like price to earnings, price to book, where the nearest pivot is, in order to define risk reward in the market. So in the risk reward section, you can see HDFC Kotak, SBI, ICICI, Axis, IndusInd, Karur, and City Union Bank. This is the risk reward column I define. In the momentum, I've selected Indian Overseas Bank, PNB, Dhanlaxmi, UCO, Canara Bank, Union, Maharashtra Bank, SBI, Bank of Baroda, and JK Bank. Now, when it comes to the balance section, that is the best of both. I've selected SBI, ICICI, PNB, Bank of Baroda, Jammu and Kashmir Bank, Maharashtra Bank, Canara Bank, Indian Bank, HDFC Bank, and something like Axis Bank. And this balance phase is where my focus is there in the market for this particular sector. Of course, I trade index futures also, but within stocks, this is how I have positioned. So heading forward in the market, you have to see whether you're an aggressive player, moderate player, or something like a conservative player. If you're an aggressive player, then realty, auto, PSE, defense, oil and gas, energy, infra, some bit of banks, metals, and FMCG should be your focus. Within this, you have to repeat the exercise that I've shown in the last couple of episodes, plot out relative strength, see which stocks have highest RS, and then see whether this is your space or you're someone like a conservative trader or a moderate trader, and how you need to go forward and build positions in sectors. And holding is important. Holding is important because shakeouts are going to be common. It is going to be the feature of this year. And you see a lot of stability right now in the US markets. But whether you're in the conservative banking space, FMCG consumption space, or in an aggressive space, pullbacks are going to be a norm in this market. And whether you in this particular market are a swing trader, positional trader, or a short-term player, index futures trader, remember what I've explained in this video. A minus 5% correction becomes a minus 10% correction, minus 10 becomes a minus 15, minus 15 becomes a minus 20% correction. Therefore, when you prepare such a matrix for yourself, if you begin entering, if you see a lot of volatility that is starting to shape up, start cutting your losses at -3%, -5%, -7%. That is 33% at -3, another 33 at -5, and another 33 that is complete at -7. In the end, you are in the game of protecting your capital. If you have capital, you will get tremendous opportunities to grow. So thank you so much for watching this video again. I'll see you next week, and please leave your comments. I'll answer the same.